I was reading the Wall Street Journal and I ran into an interesting article. Investors are bailing on Cathie Wood's popular Ark fund. What's crazy is that the Ark fund is up over 50% this year. That's more than double the return of the US stock market over the same period. And yet, investors are fleeing, pulling out over $700 million during the past year. When professional investors are leaving an investment that's returning more than double the market average, you know something is very, very, very wrong. And the kicker to this story is how predictable this result was. This story begins in the early 2010s. Joe Biden is vice president. Trump is a businessman that believes that then President Obama was born in Kenya. COVID was a disease that only bats got. Simpler times. The United States was recovering from the worst financial crisis since the Great Depression. Companies were being bailed out, going bankrupt, or being merged with other companies. No one has any idea how long the recovery was going to take or what was going to happen next. Coming out of all of this uncertainty was a huge plot twist. The stock market roared back to life, creating the longest bull market in history. I cannot overstate how absolutely insane this was. This was like the sun coming out at midnight. Everybody was caught off guard. And leading the charge was the tech industry. I mean, what the hell? These days, people have forgotten how crappy the tech industry used to be. Prior to 2008, the tech industry was a full-blown disaster. The dot-com boom had humbled investors, where an industry built on hopes and dreams was crushed by reality. Companies like Apple and Amazon were selling for less than $10 a share after the dot-com boom. But after 2008, technology was back and with a vengeance. Companies like Apple, Microsoft, and Alphabet would become some of the largest companies in America. Even companies that are tech adjacent, like Amazon, grew at an astonishing rate. Tech was hot. As the tech hype grew, it was only natural that a fund would be created to take advantage of the hype. If investors want a product, the finance industry will make it for them. You gotta make some monies on the fees after all. The Ark Innovation ETF was launched in late 2014. This ETF wasn't satisfied by taking advantage of the safer tech companies. Who needs lame stuff like Apple and Microsoft? That's just a bunch of baby boomer garbage. You gotta be more ambitious than that. The Ark ETF invested in things like DNA technologies, automation, robotics, energy storage, AI, and anything that sounds like it would be on an episode of Star Trek. Now this is an exciting proposition, but the Ark ETF wasn't cool enough just yet. Gotta juice it up a bit more. Unlike the overwhelming majority of ETFs at the time, the Ark ETF was not a passive index ETF. It was actively managed. An active fund is an investment vehicle where you pay a team of financial professionals to try to find the best investments for you. This type of fund has more fees than an index fund, but you get the chance to outperform the market. What you need to understand though is that actively managed funds are typically designed as mutual funds, not ETFs. Active managers often handle billions of dollars. That means when they wish to acquire a sizable position in a company, they can often have a huge impact on that company's stock price. Therefore, they will often try to acquire the shares slowly over time in order to minimize their impact on the stock price. Mutual funds report their fund holdings on a quarterly basis. This allows the fund manager to have a high degree of privacy. But on the other hand, ETFs must report their holdings daily. While these days there have been some innovations that allow ETFs a little bit of privacy, back in 2014, there was no good way to be secretive. You had to report everything in the portfolio. Therefore, if you're trying to quietly acquire a position, everybody else can just see you doing that if your active fund is an ETF. No privacy allowed. That means other active fund managers can copy what you're doing, buying up the stock before you do, and driving up that stock's price. But Cathie Wood had a different idea. Cathie Wood is the founder of ARK Invest, the fund company behind the Ark Innovation ETF. Instead of hiding behind a veil like the other managers, she would regularly share her thoughts on the markets, stocks, and her own research. This allowed her to obtain a lot of publicity in the investing world because she wasn't hiding her thoughts. There was one stance in particular that allowed Cathie Wood to keep everybody captivated. Cathie Wood received a ton of attention for her major bet on Tesla, believing back in 2018 that Tesla stock would hit $4,000, giving Tesla a market value of over $600 billion. This was contrary to what many investors believed, given that Tesla was heavily shorted during this period. Cathie's bet turned out ultimately to be right. Starting in 2020, Tesla stock would soar. That was the same year where the Ark ETF would more than double in value. In addition to Tesla, companies like Roku, Square, and CRISPR Therapeutics helped propel the ETF higher and higher. The Ark ETF was going to the moon, baby! The Ark ETF ultimately generated more than 150% for its returns in 2020. It won the award for Best ETF of the Year from ETF.com. But winning this award doesn't truly capture how much attention Cathie Wood and ARK Invest were receiving. For example, ARK Invest's YouTube channel currently has over 500,000 subscribers, with several talks from Cathie Wood having over 1 million views. For comparison, Fidelity Investments has under 800,000 subscribers, and Vanguard has under 40,000. BlackRock, the world's largest asset manager with over $9 trillion under management, they have less than 25,000. People also made memes of Cathie Wood, with this one being my personal favorite. Save them all, Cathie. Save them all. Except Cathie didn't end up saving everyone. Actually, tons of people would end up financially devastated because of Cathie Wood. Unsurprisingly, the Ark ETF had a massive fall. This wouldn't be much of a story if there wasn't some kind of disaster along the way. The fund previously traded at over $150 a share. Now it trades below $50. Now that is a huge fall, but that doesn't explain by itself why investors are so afraid of this fund. Why they're fleeing to the wind even though this fund's going up 50% for this year so far. There's something else here. To understand the real horror of this fund, you need to understand fund flows. This is money going in and out of a fund. For example, when you buy a mutual fund, your money is given to a fund manager who will invest it accordingly. When you sell the mutual fund, you'll take your money out of the fund. ETFs are a little different. Investors trade shares among themselves, just like stocks. If you buy a share of ARK, your investment isn't going to Cathie Wood. Rather, it's sent to somebody else who is selling the share. For an ETF to create new shares, a very wealthy investor needs to inject millions of dollars into the fund directly by working with the fund company. The available supply of shares on the market needs to not be enough to meet that investor's demand. So, using the millions that investor has, the fund company creates a bunch more shares. If we look at the quarterly fund flows, investors were injecting billions of dollars into the fund from the start of 2020 until the second quarter of 2021. That means that very wealthy, successful investors and foundations and institutions were all piling aboard the Ark, trusting Cathie Wood with billions of dollars. The biggest inflows were during the last quarter of 2020 and the first quarter of 2021. Which happens to also be around the time where the Ark ETF would peak in price. That means that the large wealthy investors bought high and got absolutely eviscerated. To give context to how bad the crash was, let's compare the Ark ETF against the S&P 500 Growth ETF from Vanguard, VOOG. During the past 5 years, VOOG would grow annually at 12.88%. Ark ultimately grew annually at a rate of 0.84%. Most decent savings accounts grew more than Ark over the past 5 years. Now remember, that's a return for people who got into Ark before the hype. It gets so much worse when you look at the time period from the peak to where it is today. If you had invested on February 12th, you would have lost over 60%, which many wealthy investors did. And thus, even though Ark is having a great year right now and is up over 50%, wealthy investors are fleeing left and right, taking what little money they have left with them. But this story does have a huge winner, a real kicker, a plot twist at the end. When it comes to money, you must always remember that for every loser, there is always a winner. As the Wall Street Journal notes, Although fee revenue is well off its 2021 peak, ARK has generated more than $20 million of fees this year. And you should remember, this year is only halfway done. ARK will likely generate around $40 million in fees this year from a fund that is worse than a savings account. That's just insane. As is the case with active funds, the fund managers are the only group that is likely to win. The ARK ETF has an expense ratio of 0.75%. That means you are paying $75 a year for every $10,000 you have invested in the fund. Paying 0.75% is a ton for a single fund. I personally am only willing to pay less than 0.1% for any of my fund's expense ratios. But ARK's high fee is so easy to ignore when the fund is doubling its value in a single year. However, the high fee adds insult to injury after the fund crashes and you're stuck with the losses while paying a ton in expenses. It's a bad deal. Now, the ARK ETF story isn't anything new. When there is a lot of hype, the finance industry starts launching products left and right in order to cash in. Invesco launched the popular tech-heavy QQQ ETF in 1999 during the dot-com bubble. BlackRock is currently trying to launch a Bitcoin ETF. If there is an appetite for a type of fund, the industry will make it. All of this ETF creation is ultimately just a process that the fund industry uses to make money at the expense of foolish investors. When there is hype around an investment idea, the industry creates tons of high-fee funds in order to satisfy that demand. Eventually, the hype dies off and the fund crashes. But that fund has already generated a ton of fees. It served its purpose. If you want to avoid the hype fund trap, follow my rule of keeping the expense ratio of your funds under 0.1%. The hype cycle is trying to get high fees from hungry, foolish investors. If you're the type of investor who prioritizes maximizing their return by keeping your fees low, you'll avoid this trap.